So for more and a deeper dive into these numbers, let's bring in Lauren Goodwin, who is the New York Life Investments economist and portfolio strategist, along with EY chief economist Greg Daco. Great to have you both here with us this morning. Okay, so if you're the Fed and your Fed Chair Jay Powell, I always paint this picture of him sipping his tea, looking at these numbers as they drop here. I don't know what he's drinking this morning, but what do you imagine he's thinking as you see the unemployment rate at 3.4% now, and you clearly still have more cushion on the employment side of the equation in your dual mandate to continue combating inflation here?
Well, I'm a tea drinker, so I like to think he's drinking tea as well. This is a really complicated number for the Fed because we know, and this, you've done a great job on this program laying out that the labor market is a lagging indicator. When the Fed starts raising interest rates, it takes time for dominoes to topple. You first see them in interest rate sensitive sectors, then in manufacturing, then in services, and only then in the labor market. And tightening credit conditions from what's been happening in the banking sector, that should be adding a little bit of wind to these dominoes and should be impacting hiring intentions in the labor market. But they haven't seen it yet. I read the meeting and the press conference on Wednesday to say that the Fed, having had a bias towards hiking in the last year, had moved towards a bias to sit still. But this data is challenging for that perspective.
Does it bring June back on the table, Greg?
I think it very much does, and that's problematic, I think, in the current environment. We are in a situation where we are seeing signs of an economic slowdown if you look forward. If you look backwards, we're not necessarily seeing all the signs of that slowdown materializing. But what the Fed did with the hawkish pause earlier this week is essentially signal that it's still willing to raise rates if necessary. It wants to pause, but it's still willing to raise rates if necessary. I think, unfortunately, this latest data reading is going to be one that favors one further rate hike. That might be a mistake in the current environment where we're seeing increased bank stress.
Certainly. And so, yeah, with the increased bank stress, and it's been a whole 24 hours since we talked about that, but, you know, as we think about just what the Fed's policy pathway has been to this point and how even within the wage side of the equation that they have to think about, because we just heard commentary from Fed Chair Jay Powell commenting on wages and how that correlation to inflation continues to be a headwind that they have to be concerned about right now. What do you do off of this report?
Well, I think what you have to do is really look at what the momentum is going to be going into the rest of the year. You can't just focus on data dependence. Extreme data dependence in an environment that is as volatile as today provides the lack of an anchor for monetary policy. And that's really what we need today. We need to be looking at the broad range of indicators that are showing that the disinflationary currents are gaining momentum. You look at consumer prices, producer prices, import prices, and even wages. We know they're volatile, so I wouldn't take one reading as being the final read. There is sign that there is a moderation in inflationary dynamics. That means that the Fed has the leisure to pause, look at the lags of monetary policy and the effects on the economy, and be careful not to be too tone deaf to what's happening on the banking sector front, because that has immediate implication for the banking sector, but indirect implications in terms of credit and economic activity going forward.
Just one quick note I want to make, and we did get revisions, by the way, for the prior month, and we got a downward revision to 165,000 from 236,000. So that's just something to take note of as we look at the trend of these numbers, and also as we talk about how they keep overshooting. That one, obviously, if it's revised lower, it wasn't quite the same magnitude. Lauren, I guess then the question becomes, is the Fed measuring the wrong things? Is the Fed data dependent on the wrong data?
I don't think so. We all have the same data. Everybody's doing the best that they can with this information, right? And the reality is that for the Fed and for everybody else, that the environment is really challenging to forecast. I think, frankly, that's true in any economic cycle. This cycle has its own flavors and differences, but late in the economic cycle, this balance between rising financial stability and economic risks with persistent wage growth and employment is actually pretty standard. It's just hard to thread the needle in this phase of the cycle. And I point to actually the last 10 recessions. In 9 out of the last 10, and on average, payrolls are looking really strong until the moment we are in recession. And so I couldn't agree with Greg more that when you get to this sort of late stage in the economic cycle, it's really important to pull back and acknowledge that the data doesn't tell us everything.
And so with that in mind, I mean, we've heard from bank CEOs over the course of this earnings season, recession Q3 2023. Does this report say that at all?
Again, it doesn't necessarily say no to that. I think
it won't until it does.
Right. Yeah. And it's one of the most important, I think, pushbacks to the perspective that how could we be in recession when the labor market is so strong? Again, historically, that tends to be true, that the labor market is incredibly resilient until the moment we are already in recession. And by the way, same for the market. There's this perception that the market tends to anticipate recessions, and historically that just doesn't bear out. The market does tend to lead the economy out of recession, but heading in, you have to see a fallout in employment outcomes. You have to see a decline in outright earnings growth. You have to see recession already happening before the market really takes that into account.
We did actually see one element that I think is noteworthy, but it's in the weeds, it's for the data nerds, but the diffusion of job growth. So what share of private sector occupations saw job gains is at the weakest in multiple years. 57% of jobs only rose. That's a very low number. That's important to keep in mind because it's the breadth of job growth that also matters. If it's one or two sectors, as Lauren was saying, these can be shut off from 1 month to the next. And we've seen that the labor market dynamics are very different than what they've been in the past. It's a hiring slowdown that has led the way, and now we're starting to see job cuts. These are non-linear job cuts. It's not all linear.
Well, and one of the points that the Goldman economists made in their preview note was that as we start to see contraction of credit, that's going to affect some sectors more than others because some sectors borrow more than others. Labor and hospitality is a sector, they say, that tends to borrow a lot. So even though that's been one of the most strongest areas, could that see some pullback? So I guess to go back to another point that I was making that you were talking about earlier, if this does put June back on the table, there are so many people now who are like, the Fed should not keep raising, the Fed needs to cut. We are in danger zone here. If June is back on the table, what's the risk if the Fed keeps hiking in this kind of environment?
Well, I think the risk, we're seeing it today. We're seeing increased banking sector stress on smaller regional banks, and there is a consolidation underway. I think some of the commentary that Powell made during the press conference a couple of days ago showed that there was perhaps not as much concern as others have highlighted in terms of the regional banking sector. And we are likely to see further stress down the road. So as the Fed continues to raise rate in this type of environment, it will increase pressures. Let's not forget, again, in an environment where inflation is slowing, that's putting upward pressure on real rates, the real cost of capital, and that is deterring business activity. So we are going to be in this environment going forward where we're going to see the slowdown in interest rate sensitive sectors and other sectors that are dependent on that. So that slowdown in inflation is materializing. Do you need to do much more? I'm not so sure at this juncture. Let's not forget 2019 or even during the COVID crisis, the Fed was a little bit late in assessing that there was this slowdown. Let's not repeat the mistakes of the past.
To pick up on something about regional banks real quick, since you mentioned it, how much of the issue at regional banks is real and how much is perception on the part of the market, given the activity we've seen over the past few days?
I think we've seen a transition in that dynamic this week because many of the banks that have been failing in the earlier days in March had what have been widely described as idiosyncratic issues. But the reality is that these banks' business models were much more sensitive and perhaps not mitigated from a risk perspective to the rise in interest rates. And whether it's the pace or the level of interest rates is unfortunately immaterial at this point. What we've seen this week is banks that are strong franchises that had strong levels of deposits reporting earnings in just the recent weeks, again, looking pretty good, and experiencing a slow run on the banks from the market, a confidence issue. That is not the Fed's goal. But what I will say is that slowing the economy And understanding that interest rate sensitive business models, as Greg is pointing out, are going to be experiencing this slowdown is the express purpose of raising interest rates in this environment. Cutting inflation off at the knees is, the Fed perceives, the most important thing for the long-term health of the economy. That's why Powell keeps saying over and over, without price stability, the economy works for no one. And so while, of course, seeing layoffs in certain sectors, and especially concentrated layoffs, seeing banks fail is not what anybody wants to see. The Fed can't come out and say, like, this is the point of this policy, right. But this is the point of this policy, is to accelerate the disinflationary process that we've only just started seeing.
Just want to bring this to people's portfolios. If you are waking up this morning, you read this report, you're trying to anticipate how the Fed is going to perceive it as well, and how this changes their calculus, what's the first trade you make this morning?
A couple of things to keep in mind for investors. The first is that the very cause of this wailing, gnashing of teeth and volatility is also an incredible opportunity for investors for the first time in a very long time. We have been relying on price appreciation for 15 years to add value to a portfolio, and the income generation aspect of portfolio allocation is back. That is so important. And most investors are over allocated to stocks. And so a reallocation in a portfolio to bonds in many cases makes sense. Taking advantage of higher yield and what we expect to be a more moderate yield and inflation macroeconomic environment ahead. Another thing that I think investors can consider is that because there's a lot of volatility and risks are rising, it can be easy to run for the hills. But this Fed pause window that we may be entering soon also enters an opportunity for, frankly, if not just a sideways market, some real positive upside days. So staying invested and thinking creatively about what defensive sectors mean. The digital infrastructure, energy infrastructure, the sectors of the economy that are benefiting from more global macroeconomic trends, there are opportunities out there in the market, and it's important to stay focused on sort of keeping to your plan.
Guys, thanks so much. This was fun.
Thank you.
Appreciate it. Lauren Goodwin, New York Life Investments portfolio manager and economist, and EY chief economist Greg Daco. Thanks to you both. Appreciate it.